All right. Welcome to those of you on Zoom and those of you live in the room here with me, and anybody watching this on YouTube as a live stream. We're going to get started now. I do encourage questions and participation from those of you who are able to participate. This is a class on understanding appraisals. So what I want to cover today and go over with everybody is what is an appraisal? Who is an appraisal for? How does the appraisal contingency work? How do we protect our buyers around appraisal issues that come up? How do we protect our sellers for those appraisal issues? I want to talk about something called appraisal bias, and then hopefully have time to take all your questions. Does this sound good to everybody? Yeah? Okay. And if there's something that I didn't say there and you want it covered, we will cover it. All right. Thank you, Cynthia. Okay. So, what is an appraisal? An appraisal is a report. It is somebody who's gone to the house and done a report. Somebody called an appraiser has gone to the report and gone to their property and done a report about the value of the property. What is it, quote unquote, worth? They come up with a number which we call the appraised value. And they do this in one of three ways every time. Usually they do two ways of three. There's the sales comparison approach, the cost approach, and the income approach. You might remember these from real estate school because they do go over this in real estate school. The sales comparison approach is most similar to us doing comps. When we run comparable sales data, when we're trying to find out the value of a property when we're meeting with a buyer or a seller, we look at comps, similar properties sold in a recent period of time in the same area. Appraisals do the same thing. Appraisers do the same thing as their main method for residential housing. But there are two other ways that appraisers can determine value. One is the cost basis. An appraiser will advise what they think the value is based on how much it would cost to re the property today. If the property were built today, how much would it cost? So that's the second method. And then the third method is something called the income approach. And in the income approach, they're trying to measure how much the property would generate in money and profits in revenue. So typically an office building in terms of leases, or a multi-unit apartment building. How much would it generate in leases and rental income that would, and they use that to figure out how much it's really worth in the marketplace. One thing you need to know about appraisals is they are a snapshot in a value at a specific moment in time. It is not what it was worth yesterday, and it's not what it was worth tomorrow. It's what the appraiser says that it's worth today. And because it's at a specific moment in time, it has a limited lifespan. And the older the appraisal gets, the less we can rely on it. Because as time passes, things happen, markets change, value changes. One thing I want to stress is that an appraisal is not the same as a CMA or a comparative market analysis that we do, even though it often uses a similar technique to get the value. Why? Because appraisal industry is heavily regulated. Okay, they can't just be any way. There are specific rules. And these appraisals, unlike us real estate agents, are told you can't use as comparable sales properties that don't fit inside a certain comparable measurement. So if it's too old, they have a strict cutoff for age. They have a strict cutoff for distance. Um, they also, an appraiser must be very specific about usable living space and what is not usable living space. They also have to evaluate things differently if an addition to a property was done with a permit or without a permit. And those are things that we have a lot more leeway on. So for example, if somebody converts a garage into a beautiful living bedroom, we would count that as value. But if it was done without a permit, the appraiser has to discount it completely. It's just a garage. So that's a big deal, can add up to a lot of money. Whereas a CMA, or a comparative market analysis, is a professional estimate of value by a real estate agent or a licensee. The appraisal is based on these other factors, and is this more restricted in what they can look at. So there's a couple of blog post links. At the end of this workshop, there'll be a link for you to get the slide deck. When you get the slide deck, you can click on these links, and these links go to blog posts about how to talk to an appraiser, and there's a bunch of blog posts here in this package. And the next one is about comparable sales appraisers can't use versus the ones that you guys would use in your normal business. So there's the great resources online about how to think about appraisals versus the way you would do comps. And I want to mention, it's important, is that neither your comps, or which is a professional opinion, or the appraised value is the same as fair market value. So the question is, what the heck is fair market value? Does anybody have an idea what fair market value is? Anyone have an idea?
It's like the media of the comparable sales in square feet. It's like the comparable media, not the higher,
No, it's not median value. You're talking about something called median. Nope.
Can I say?
Yeah, sure, Cynthia, please.
It's what the property is worth,
So
the value.
an appraised value says the property is worth this. And when you do your professional analysis, you say the property is worth this. No, so no, fair market value is not that. What fair market value is what a buyer is willing to pay and a seller is willing to accept. That's all. If a buyer is willing to pay more than you think, but then the fair market value is that. If a seller is willing to discount the price, then the fair market value is that. As long as the relationship between buyer and seller is what we call arm's length. Arm's length, which means there's no relationship. You're not selling to your child or to your parent or to your buddy, right? It's a regular transaction. Then we have this concept of fair market value, which is only what a buyer is willing to pay and what a seller is willing to accept. This is important for you to understand because the appraiser may say it's worth X, but the buyer and seller may choose to ignore the appraisal and say the property is worth Y. So more example, appraisal says the property is worth $1 million, but the buyer and seller are in contract for 1.1 million, and they sell the property, deal still goes through, even though the appraisal came in low. So the fair market value is 1.1 million, not the 1 million that the appraiser said. So it's important to get this idea. All right, so I think it's important as part of this presentation to look at an appraisal report. Now I have blacked out the actual details because this was a real file, but these reports are written in a style from the 1950s. They're awfully difficult to read. So I'm going to try to demystify them for you so you can go see one. When you see one in real life, it doesn't completely freak you out. So page 1 identifies the address, the owner, the detail, the concrete facts about the property, and it shows that's all in this first section called subject. In the second section called contract, it says what the sales price is, that the buyer and seller are negotiated. Okay. Then in the third section, there's some stuff about the neighborhood. And then in the fourth section of the first page, there's stuff about the site where the property is. And then it shows you a little bit more detail about the property under improvements, including appliances, rooms, descriptive stuff. That's all on page 1. Notice, page 1 does not tell you anything about the appraised value. It's just a description of the property as the appraiser sees it. Page 2, the appraiser begins to look at comparable sales, the top 3. So if you look at this chart, the feature column is at the left, then you've got your subject column. That is the property being appraised. Then you've got comparable sale 1, 2, and 3, and then it describes and compares them with their features to the property that is being appraised, and it does adjustments if necessary. So if you look at comparable sale number 2, which is the second to right column, you'll see negative, you'll see minus 4,000, then minus 5,000, then plus 10,000, then minus 10,000, then minus 9,000. So the appraiser is making financial number changes to the value of that property to sort of compensate for big differences in the property. So this appraiser is saying that the property number 3, subject comparable number 3, is in, if you look at this condition line, it's hard for me to highlight it, but the line that says condition, it's got a C3 condition, which is defined later in the report. But the subject property has a C4 condition. So because the condition C3 is considered better than C4, the appraiser reduces the sale price of the comp by 5,000 to sort of compensate for the fact it's in better condition, because he's trying to make things reasonable compared to the property that's being researched. Another example is the size of the property. The subject property is 840 square. This is under gross living area. The size of the subject property is 840 square feet. But the size of this comp number 2, the one in the middle, third column, second column from the right, is only 580 square feet. That's a pretty small house. So they've increased its sale price by 10,000 to compensate for that, because people will pay more for a house that is bigger. So they make all these adjustments. And at the bottom of this chart, they have something called adjusted sales price of comparables. And they do it, and so they came up with 317, 340, and 320 for these 3 comparables. At the bottom of page 2, they tell you their valuation of the property. They don't put it in a nice big bold with arrows pointing to it and bold and underlined in a different color. No, it's a quiet little line. It's a quiet little line where my pointer is right now, if you can see my pointer. Indicated value by sales comparison approach. It's the last line of the second to last major box, showing 320. The top line of reconciliation shows how much the 320, what the second, they always have to give you two methods. So remember I told you there was sales comparison, cost approach, and income approach. The second method they chose was cost to be rebuilt, 340. At the bottom of this page, they give you their final statement on it. Based on a complete visual inspection of the interior and exterior areas of the subject property, blah, 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 blah. Our opinion of the market value as defined is $320,000 as of this date. Wow, 320. Does anyone remember? You might not have even noticed it. The sale price, $365 under the contract section on page 1. So you go down to page 2. So when you get these reports and you want to quickly see what it appraised for, if it isn't in your email, you go down to the bottom, you see 320. Now let's suppose you're representing the buyer here. Is this good news or bad news? It could be bad news, but it might give you leverage with the seller. You're in contract at 365 and appraiser says it's only worth 320. It's definitely bad news if you're the seller, because the buyer is going to maybe walk away from the deal and maybe not want to, maybe you'll have to reduce your price. So it's bad news for the seller. Could be bad or good news for the buyer, depending on their financial situation. That's a huge discrepancy on such a low sales price. It's more than 10%, right? Wait, it's about 10%. It's almost, it's a $45,000 discrepancy. It's a 15% discrepancy nearly.
Yeah.
That's huge. So anyway, there's a lot more pages, 26 pages in this report. So they told you how they figured out the numbers for the other approach. There's some CYA and some more detail on the next page. And then the appraisers, things that they did and their certification. And they sign it, date it, that's all fine. Then they tell you what all these codes meant. There's the C3 versus C4 I'd mentioned before. Quality rating definitions. You don't have to read all this stuff, but it is interesting. All of their abbreviations and what they mean. See what I mean about a report being out of date? We would never put a report together like this nowadays, but they're still using it in this format because the law hasn't changed. And they had 2 other comps that were not really relevant for the analysis. They got 2 other comps that had different prices. They're here on this page. And then there's more information justifying the price that he gave to it, why he gave that price, all the things he did. There's some pictures. Didn't show that great. And then you can look and see how he got to this place. This is all relevant if you want to dispute it, for example. Then they show you a picture of where the property is on a map. This is called a plat map. We see these in title and escrow preliminary title reports. Then there's more. Is there an aerial map here? It doesn't look like it. Place for an aerial map. Market conditions addendum. One, and that is some just general data. Again, he's justifying his price. And then his certificate, say he's got a valid license. And then his insurance, very thorough. And I think that's it. He did a picture. Yeah. That's an appraisal report. The most important thing you need to be concerned about on the actual report, the first thing you should go to is the bottom of page 2, where in that very bottom section, in the bolded text under reconciliation, they tell you what they're evaluating at. Okay? All right. Any questions about this before I move on?
What is the term of that appraisal can be, truthful or valid?
Good question. It depends on how quickly the market conditions are changing. And banks, all the different banks will have a different policy around how long an appraisal is good for. Generally speaking, appraisals are good for the life of a typical transaction. So your buyer wouldn't have to worry about the appraisal being out of date in the 2 weeks between when they do this and when they close. But if months go by and the market is volatile, the bank might say, we need a reassessment. All right. So some things to think about, but appraisals. They are usually required by all lenders. Most lenders will not allow a buyer to buy a home without the bank having certainty that the home, an appraiser says that it's worth what the buyer is paying for it. It's completely reasonable when you think about it, because they're putting up more money. The buyer is putting in maybe 3.5% on an FHA loan, maybe 20% on a conventional loan, maybe even 40%. But rarely are they putting down 50% or more, and the lender has to protect their interest. So they require an appraisal. Typically, the buyer pays for the appraisal too, even though it's really for the lender. Some lenders have promotions from time to time, but normally the buyer pays for it. Typically costs now between $600 and $1,000 for an appraisal. There are different ways that appraisals are done. The typical way we think about it is the appraiser drives out to the property, he takes out his measuring tape, and he goes around. That's just one way. There's a lot of different ways. You can have things called drive-by appraisals. You can have appraisals that are waived. And this blog post talks about some of the different ways that appraisals get done. And there's lots of good information about all of those online. So as buyer's agents and seller's agents, we need to be thinking about this because it comes into play when we either receive an offer as a seller's agent or write an offer as a buyer's agent. Because the standard agreement, the standard purchase agreement, has a line item in it that gives the buyer a cancellation right if the appraisal is unsatisfactory to the lender. And it gives the buyer a certain number of days to determine this. And the buyer optionally can choose to have it or not have it. And that's called the appraisal contingency. Okay, and that contingency applies to the price or condition issue. If the appraiser says, I would not, the house is only worth this money if the hole in the roof is repaired, then that becomes an element of the appraisal contingency because it's a condition issue that has been linked to the price, right? So how does it work? The buyer has X number of days, whatever the contract says, after the offer is accepted to take action on the contingency they put in place. Let's suppose those number of days, let's suppose X days is 10 days. 10 days come and go and they do nothing. The contract remains in full force even if the buyer does nothing on the contingency, unless the seller forces their hand. The seller can force their hand and say, Mr. Buyer, you were supposed to remove your contingency 3 days ago. If you don't remove your contingency by 2 days from now, I'm going to arbitrarily cancel. But if the seller doesn't send out such a message, then they can take as long as they need. As good buyer's agents, we don't let that happen though. We want to be professional. We want to run this like a proper transaction. We don't want to play games. So as a buyer's agent, we would absolutely be taking some sort of action on the deadline day, communicating that with our buyer, discussing with our buyer in advance, and then communicating that to the seller's agent on that day or the next morning at the very latest. So let's talk about what happens. Let's say a scenario where the appraisal comes in at the sale price or higher, and there's no worry about condition issue, no hole in the roof. Typically what happens then is the buyer, what we call waives the contingency. They basically release it. They advise the seller in writing, we are lifting or releasing the contingency for appraisal, and the deal keeps moving along, okay? However, we have an issue with this appraisal contingency if the appraisal comes in lower than the sale price or has condition issues that might concern the lender. Could be an issue for the buyer. Like in our example one, it was in contract for $365, the appraisal came in at $320. So that was an example of this second possible outcome, right? This is discussed in detail in section 7B of the contract. You can look at that later. So what happens if the appraisal comes in low? Number one, the buyer has three choices and the third choice has three options. Buyer's option number one is to say, Mr. Seller, I don't care. I will manage the money around the difference between my price with you and the appraised value. I'm going to waive the appraisal contingency anyway. The buyer's second option is to cancel the agreement. Mr. Seller, there is a $45,000 discrepancy, a 15% discrepancy. I don't want to buy your house anymore. And they can walk away under the terms of their contract with this optional contingency. Do they get their initial deposit back? Anybody know? Any guesses? Do they get the deposit back? Anyone on Zoom? The answer is yes. The contract says that if they, at the end of the time period, they either waive the contingency or cancel the agreement, and their cancel of the agreement being a term of the contract means that they get their deposit back. The seller is required by the contract to release the deposit. However, what happens a lot when the appraisal comes in low is some variation on number 3 here, which is a request for a change to the contract. The buyer says to the seller, well, now we have a problem, Mr. Seller, because we have this 15% discrepancy or whatever it is. I need you, Mr. Seller, to agree to make some changes to our deal. The buyer can normally ask for 1, 2, or 3 of these things and maybe 2 of them together. One thing the buyer could do is say, Mr. Seller, I don't want to pay you $365 anymore. I only want to pay you $320. You lower the price. The buyer could say, Mr. Seller, the appraiser says you got to fix the hole in the roof. You fix the hole in the roof, we still have a deal. But it's a negotiable thing. The seller doesn't have to say yes. Sometimes you might, as a buyer's agent, advise your buyer to just ask for more time. Maybe you felt the appraisal was unjust and that the appraiser made a mistake. Maybe you felt that it would be, that you wanted to research other options. And we'll talk about some of those other options. So, and a time extension is very common. Mr. Seller, the appraisal came in low. We need a week to figure out our options. Why would a seller agree to a time extension?
To give it time to the buyer to find the.
Yeah, but why would they agree to that? Mr. Buyer and Mr. Seller, they have an agreement that they're going to go 10 days for this. And now the buyer in the right in 10 days is saying, I need another week. What is the motivation of the seller to agree to a time contingency extension?
The motivation to the seller is do the business, do the deal.
Yes, the motivation of the seller is to get the deal done. The thing of it is, guys, yeah, that's on the buyer side. A second appraisal is on the buyer side. But why would the seller agree to an extension? It's because it is a lot cheaper for the seller to keep the deal together than to go back to the market. Because if the seller goes back to the market, he has to tell buyers that he had a low appraisal with the last buyer.
Mm-hmm.
Do you think he's going to get the high price again? Absolutely not. He is very motivated to keep this together. All right, so let's talk about why low appraisals create a big value issue for the buyer. So let's imagine it's a $1 million sale price with 10% down. So 10% of 1 million is 100,000, which means the loan is 900,000. Okay. So that's 90% financing. But the appraisal doesn't come in at $1 million, it comes in at 950, which is lower by 50,000 than the sale price. This is very common, right? Why is this a problem? Because buyers' lenders will only provide financing for the 90% that they've committed to of the appraised value, not 90% of the sale price. It isn't the sales price that's relevant for the buyer's lender. It's what the appraiser says the property is worth. So 90% of the appraised value of $950 is actually only $855. When you add the $855 to the $100,000 the buyer is contributing, we're at $955, but the contract price is $1 million. The buyer is $45,000 short. Notice, by the way, that they're not $50,000 short. They're only $45,000 short. That's math for you. But it's still a big problem. Who is going to pay that $45,000? This is why the buyer might negotiate with the seller to reduce the price, unless they're sitting on $45,000 that they want to spend cash. If they're only 10% down, they probably don't have a ton of money beyond that. So, what are the buyer's options here? Well, they could absolutely request a price reduction, maybe 50-50. They can absolutely do that. That is absolutely one option, okay? They could say, okay, they could request the seller to make repairs. We talked about that. But the extension of contingency is an interesting opportunity here, because that leads them with other options. So if they ask for more time, they don't immediately go to the seller and say, reduce your price. They say, we need more time. They could, and this was suggested, one of these, there's three options. Number one, they could work with their existing lender to reduce their down payment, maybe to 5% down, so that they have the cash to cover the shortfall. If they reduce their down payment to 5% of $1 million, that's $50,000 right there. Boom. Now they can pay the shortfall. Now, it does mean a higher monthly payment, but maybe they're okay with that. They can dispute the appraisal. They can go to the lender and say, or to the appraisal through the appraiser, and there's a whole formal process. We disagree with your use of this comp. This comp should have not been used, or that comp that you didn't use should have been used. They can dispute it. The third thing they can do, and this was somebody suggested this in chat, is they can request a new appraisal, either from the current lender or from another lender. You can switch lenders in the middle of the game. I did that a few years ago with great success. So there's options. I really love this grant extension contingency. It's a lot less crazy for the seller. You give the seller, you tell the seller the appraisal came in low, and you said, we need to do some research about this. You're not asking them for anything yet, really. You're saying, give us a few more days to do our due diligence, because if they can make it work with a new appraisal, maybe they don't have to go back to the seller and ask them to reduce the price. Now, they may wish to. Your buyers may wish to. They may say, listen, I'm not going to pay more than appraisal says it's worth. That's okay too. It is not actually your guys' decision. You might recommend one of these three, but it's your buyer's call, not yours. You need to explain these options to your buyers so that they understand their choices. Some of your buyers will have already run this through ChatGPT and be pretty sophisticated, but the vast majority will not have done that, and will be relying on your expertise to help them figure out what to do. So the question came up, if we have a loan contingency on the contract, do we need an appraisal contingency? The answer is yes. Actually, I want to show you something. Back in the contract on section 7B, I was showing you before, if you look at section 2, no appraisal contingency. If the buyer doesn't have appraisal contingency, then buyer may not use a loan contingency to cancel this agreement if the sole reason for not obtaining the loan is that the appraisal came in low. So it's actually, you absolutely cannot do what was the person in chat thought about. Can't do it. All right. So moving forward, this is an article about low appraisals and some of the options that this blog poster, this is a lending company, 5 options when the appraisal comes in low, some of which we've discussed already. Yeah. So get some more resources for you about that. All right. So best practices. What are we doing for time? What time is it?
It is 3:35.
3:35. Very good. Okay. Best practices, guys. First of all, when you are a buyer's agent and you are thinking a low appraisal is possible, you should discuss it with your buyer before you write the offer, not after you've been in contract a week. You want to discuss it with them before you write the offer. Now, you want to do that not just so they can decide whether to have an appraisal contingency or not, if there is any doubt, but also to make sure they have enough cash for the different outcomes. If the appraisal comes in low, is there any cash to cover a low appraisal? You want to have that conversation. Or if they don't have any cash, are they going to be ready to cancel if the seller won't negotiate with them? It's better to get expectations right with your buyer so there's no shock. Because if you're worried the appraisal might come in low, you want your buyer to be ready for it if it actually happens. I also recommend, before you write the offer, to discuss it with your buyer's lender. Hey, if the appraisal comes in low, what kind of options are we going to have? They may have some creative options that another lender doesn't have. That's worth talking about. As a buyer's agent, you should contact the appraiser before the appointment, even if you weren't scheduling it. You want to know their experience appraising in that neighborhood, their experience with that style of property, condo versus house, old Victorian versus Eichler, whatever it is. Ideally, you should attend the appraisal in person with your own comps. Make sure the seller is aware of all your comps and a list of improvements the seller made. And there is a post here on a blog post you can link to from here about sharing comps with appraisers that I think is really helpful. Now, if it's a competitive offer scenario, if you're going to be knowing you're competing with other buyers, you should talk about the appraisal contingency waiver with your offer, which is in section 3L2. Okay, and you'll notice under 3L2, appraisal contingency based on appraised value at a minimum of purchase price or, and then the checkbox and a dollar amount. So if you know it's going to be competitive, you might want to have a conversation with your buyer about, let's build in a appraisal waiver. Let's build it in and let's say to the seller, hey, your $1 million property, so long as it appraises at 950 or better, we're good. We're already willing to pay the extra amount because as a buyer, you are so much want this property and you don't want them to take another offer that, but you still want to have the appraisal contingency there for worst case scenario. So in this example, in this picture, there's an X, no appraisal contingency. But you could just as easily do a partial waiver where you have an appraisal contingency so long as it appraises at a specific amount. By the way, be careful with this if it's an FHA or VA loan. If your buyer is using FHA financing or VA loan, talk to the buyer's lender before you do anything about this. Now, let's suppose you're the seller. You're the seller's agent. You're the listing agent. Now we're on the other side. You're getting in offers. If the buyer's offer has an appraisal contingency, you want to talk about it with your seller before you accept the offer. Never assume, oh, it's going to appraise for sure. Your seller may be thinking it is going to appraise, okay? But you have to talk about this anyway. There's always the chance that it doesn't appraise. Market conditions change very fast in the Bay Area. As a listing agent, you may wish to attend the appraisal in person. You have even more motivation to go in person than the buyer's agent does, with a comps and a list of seller improvements. You might want to talk to your seller about having a backup plan in place, if necessary, to help the buyer with new financing options if needed. What do I mean by that? You represent the seller. Maybe you want to get him, if you're worried about the appraisal, maybe you want to get your seller with your lender to see if your lender can get an appraisal that'll work for the buyer so that the deal has got a kind of an insurance policy, right? A little bit of protection. Maybe your lender is such a great awesome lender, they'll be able to offer a better interest rate that lowers the cost for the buyer, that the buyer can bring in the extra money. I mean, there's all kinds of ways to structure it. The point is, you want to have a backup plan. Maybe your backup plan is a backup offer. Maybe you've got another buyer in the wings so that you don't have to lower your price if the appraisal comes in low. Every situation is different. Your mentor will be very helpful here. And of course, you can always ask me when you get into these types of things. Okay, I want to talk about appraisal bias. This is the last part of this. Appraisal bias means prejudice and discrimination. And appraisers are not exempt from it. You know, we talk about fair housing law in terms of agents being and sellers and buyers, but appraisers also are sometimes biased. And they may make decisions based on the neighborhood and how they feel about the neighborhood personally, or what the owner's possessions are. This is why we ask sellers to remove personal pictures. Sometimes we ask them to remove religious artifacts. Anything that other people may choose, or maybe political slogans, because sometimes buyers, but also appraisers will make judgments, unfair judgments. We know this is a problem because there was a report in 2022, which is not that long ago, that over 12% of appraisals for homes in Black neighborhoods and over 15% in Latino neighborhoods came in below the contract price. But in the white neighborhoods, only 7.5% did. That's clear evidence. So, you know, we want to be on the lookout for that too. The contract actually talks about this. In section 29, it says what you should do. Section 29B, if a buyer or seller believes that the appraisal has been influenced by these fair housing violations, the seller or buyer can report this information to the lender or mortgage broker that got the appraiser, and may also file a complaint with the Bureau of Real Estate Appraisers. And then there's a number. Now, guys, we have a fiduciary duty to advise our buyers and sellers. Even though our buyers or sellers may not want to do any of this, they may not want to rock the boat, you must advise them about it if you fear that that's happening here. Even though it complicates your lives, you have an obligation to do this. So keep an eye out for this sort of thing. On the subject of bias, there are 3 great resources I wanted to share with you. This is also much more than just appraisal stuff, but there's some great classes that we offer on our website. One's about unconscious bias. That's about the bias that we don't even realize we're exhibiting. We make judgments about people without even realizing it. And then The Color of Real Estate is about the history of discrimination in this country. And then Long Island Divided is a terrifying documentary. I encourage everyone to watch it, about what happened when they posed as real estate agents in Long Island, and how these I'm sorry, I said it wrong. These documentarists, these reporters, they posed as buyers and sellers, and how they were treated by the different real estate agents who did all kinds of bad behavior across a wide variety of real estate firms. So that is a good resource as well. All right. Does anybody have any questions? Any other questions?
I want to know about the experience that I have in my country when a commercial property, the owner has he has this property overpriced.
Right.
But they are sometimes like blind. So sometimes we usually what we try to make is go with your lender, and if you want to know the real price of the property, ask to your lender how much money they will offer to you for in this property. So it's like the kind of way that we try to place the consciousness of the real price of the property and with the owner. I don't know if we can do this.
No, because here the lenders won't do it. The lenders will
Mm.
call in an appraisal. You can't get financing in this country in a regular financing without an appraisal. And the appraiser, the underwriter, the people for the bank will assess what kind of an appraisal it can be. Sometimes they waive them. We're not worried. But if they're worried, they won't say how much it's worth. They will always bring in a third-party appraiser, which is what we've just been talking about.
Okay.
All right, so a question came up in the chat, and the question was, and I have to read it, 1 second. Here's the question that was asked. Is the sorry. It's hard for me to get it back on the screen because, hold on. Is the appraisal report open to the public? No. It's purchased by the buyer on behalf of the buyer and for their lender. And in fact, it only needs to be disclosed to the seller side if you're canceling the deal or if it becomes an item of negotiation. You got to show the other side that the appraisal really was what it was. But it's not a public report. It is not in disclosure packages. Is there a way as a buyer's agent we can check if the property had some low appraisal report recently? Well, you can call the listing agent, but generally speaking, if there was one, so if a listing agent is aware of a low appraisal, they have an obligation to disclose it. Okay, if a seller did an appraisal before they went on the market and it was low, the seller then has an obligation to disclose that appraisal. But that's all you can do. There's no general database that you can go to find out what a property is appraised for. I hope that answers your question. Does anybody else have any questions? Oh, another question, or at least another comment. Okay. All right. Does anyone else have any other questions?
I have a question, Stephen.
Okay.
Yeah. So we talked about appraisals' importance for financing. I'm curious if it's still important if it's an all cash offer.
Oh, I am so glad you asked that question. By the way, I've put the QR code up on the screen. Take a picture of it with your phone so you can get a copy of this presentation. That is such a great question, Priyanka. Thank you so much for asking it. Generally speaking, buyers with cash do not get appraisals because they have determined the property is worth that much and that's what they're willing to pay. They don't need any third-party appraiser to justify what they've decided to pay, generally speaking. And they don't have a third-party lender they have to satisfy around the value. They've agreed that it's worth that much. They're willing to pay the seller that much. It really doesn't matter what an appraiser says. However, there is an exception. Sometimes you will have a cash buyer that is being represented by a third party. In the case of like a trust buying a home for a family member or some other purchase where a third party's maybe an investment group is buying a property all cash. In that case, the person who is executing the purchase agreement is acting as a fiduciary for the buyer or for the buyers. And so that person who is the person signing the real estate contract, who is the representative of the buyer, if you will often get an appraisal as part of showing that they are fulfilling their fiduciary duty and not overpaying for the property. I had it happen once years ago for a bank agent, someone who the bank was with a bank, and she was signing all the paperwork. The property was being purchased on behalf of a person who had a special trust with the bank, a special needs trust with the bank. And so the person who had the special needs trust was going to be the beneficiary and get to live in this property, and it would be in his ownership, but he used the services of this trustee, if you wish, to manage all of his financial affairs. And so she had to legal obligation, this trustee, to show anyone who might ask, including her client, that she wasn't overpaying for the property. So we did get an appraisal for her on a cash purchase. So it happens from time to time, but most of
Okay,
the time it doesn't happen.
got it. Thank you.
Does anyone else have any other questions? Okay, then. Thank you guys all for being here and letting me share with you my feelings about appraisals and tell you about appraisals and how they work. And we'll send you the presentation if you requested it, so you can get those blog links. And I'm going to be teaching another great class the week after next on Teams. And I've got a lot of good classes almost every week, so stay tuned. Also, the whole library of my classes is on my coaching page, which you can look at all the old classes there that I've done. All right. Thanks, everyone.
Thank you so much, Steve. Yeah. So as in Colombia, es